All right, in this episode, we're going to chat about investments. So, people don't think that investments are big decisions, but they can be depending on what you're investing in. So, what types of investments are there? Well, there's a savings account at a bank that might get you a couple of cents a month or whatever, depending on how much money you've got saved in there, of course. Or there could be the investment in cryptocurrency, which could make you huge money or lose all your investment. And then there's a whole ton of different investment options in between. So we're going to kind of look at some of those and kind of the investment vehicles that you can do, because there's some things that'll save you tax or defer you tax. So those are types of things that we want to look at in this video, and we'll go through some of those right now. So let's start with the savings account at the bank. So if you're going to save in an account, you want to make sure it's an interest earning savings account. It'll never go down, but it really won't go up either. You'll earn your couple of cents a month, of course, depending on how much you put $1 million in there, you're going to earn a couple of bucks a month. But if you're saving $50 a month, you're going to earn a couple of cents a month is really what you're going to get on your high interest savings account at this point in time. So it's a good, safe zone if you are panicky about where cryptocurrency might go this afternoon. Whether it earns lots or loses lots, that might just not be for you. But there's a whole ton in the middle. So let's chat about some of those that are in the middle. So, guaranteed investment certificates, or GICs. Those you can buy from a number of different places, mainly the bank. They love GICs. And those will get you more interest than what a high interest savings account generally would. So those are guaranteed, so then you don't have to worry about your investment dropping. Next type of thing is a mutual fund. So a mutual fund is a whole bunch of stocks in the stock market that are wrapped around in one fund. Mutual funds trade at the end of the day. So in the stock market, which we'll chat about in a few minutes, goes up and down all throughout the day. Mutual fund is what did it end at yesterday and what did it end at today. That's its trading points, is always at the end of the day. So there's not as much volatility in a mutual fund, even though the individual stocks in a day within a mutual fund go up and down. Because mutual funds are traded at the end of the day, they just trade at one point. And so you don't have to worry about it. So getting into the stocks now, a little bit more risky than a mutual fund, because a mutual fund's got a whole bunch in there. The stocks, if you buy in individual stocks, those are going to go up and down every second of the day. And then at the end of the day, the markets close, and that's what it's worth. But throughout the day, you can buy and sell. And hopefully, you buy low and sell high. Sometimes it doesn't work like that, depending on who's tweeting what or who's saying what out in the market. You need to be a little bit more educated, if you will, to buy into stocks. Or chat with a stockbroker. I'm sure they've got lots of good tips. They do want to make you money, because if they don't make you money, you're probably going to leave them, because you are paying them for that service. So that's another place to invest money into. Another one is through insurance companies. Insurance companies have a little more guarantees, but they're not the guarantees that you think of like a guaranteed investment certificate. They are guaranteed in if you were to die or if it hits a certain date, then they're guaranteed at a certain value. And so obviously you pay for that within the product, which is called a segregated fund, but it's guaranteed. So if you're a high risk taker and you go into a high risk segregated fund and it goes up and down because it trades just like a mutual fund, because it is a group of stocks within there, but it trades up and down, at the end of every day, and the day you die, it's down. Well, guess what? There's guarantees on that, so that whoever you've listed as your beneficiaries, they will have a set amount of what they're guaranteed for, even though it might be down. So that is usually a good idea for those that are older, maybe in retirement, that they would invest in segregated funds for at least some of their money so that they've got some guarantees in there as well. And then, of course, we'll pick the big topic of the day, which is cryptocurrency, which seems to change every single day, up, down, all over the place. So there again, with cryptocurrency, very risky, but for some people, if they got in low and they're selling high, they're loving it. If it's, I was chatting with a gentleman the other day, and he's like, I'm going to wait to pay my taxes because the cryptocurrency that I'm in, is making money. And so because he was making so much money, he's like, well, even if the government's going to charge me 5%, I'm not going to worry about it because I'm making way more than 5% in my cryptocurrency investment. Sadly, a couple of weeks after taxes were due and he hadn't paid his taxes, cryptocurrency had fallen quite significantly. So, you're going to have those risks within any investment, except for the GICs or the savings account at the bank. They are going to go up and down. And really, take your gains, but have it set in your mind that if it goes up 20%, that you're going to cash out that growth and put it maybe into something safer or reinvest it into something different. As opposed to just going, ooh, I'm up 20%. Man, I told myself I was going to cash out the excess once I was up 20%, but now that I'm here and making this money, I'm going to keep going on it. But guess what? At some point in time, it is going to drop. It'll come back up, but when is that going to be? And so that's where you have to look at, what is this money for? Is this money for one of your big purchases? Whether it's for your house or your car or whatever that might be. You need to look at what is your risk tolerance, and if it gets to that certain point, stick to it. Sell it out, because you're still going to have, say, the base amount that you had in there, that may still grow, or it may go down, but at least you've got the gains in there already saved up and earned, because you've moved it out of that investment. So you want to look at those types of things and stick to your plan. Always have a plan. Don't just fly by the seat of your pants and go, it's making money, I'm going to stick with it. It's going to come down at some point in time. So where can you put all these investments in? Well, a lot can go into RSPs, which will give you a tax savings on your tax return and defer growth or tax on the growth for later. Tax-free savings account doesn't give you any tax benefit today, but on that growth of that money within that account, whatever you invested in, whether it's the bank account savings at the bank, or whether you're in segregated funds or a stock or mutual funds, you get that growth tax-free. So that's a good option as well. And then there's also the RESPs or RDSPs that you might be saving for children's education or for yourself or a child that qualifies for the disability tax credit for their retirement. So there's all those things that can be invested inside there. And so you want to be able to research that and look for those types of things so that you can benefit from those tax savings. So thanks for watching this episode. Grateful that you're here. Keep watching and subscribe so that you can make sure you're notified when the next one comes up. Thanks.